Back, and we are in the red today across the board. Modest losses for the S&P and the Nasdaq. Dow still down about 0.5%. The S&P retreating from last week's record high, powered by big tech earnings. My next guest says, while we need to see market breadth beyond big tech to sustain the rally, she's betting on growth stocks to outperform value in a lower interest rate environment. Joining me now, post 9, is Corient's Amy Kong. Welcome back.
Hey, Scott.
So just top-heavy market is okay? Just keep betting with what's working?
You know, the expectations for some of these tech companies that have reported last week has obviously gone much higher now. It's been high since the end of the year, and I think given what we've seen, the consensus expectations have moved even higher. That is a concern of mine. I think there is just less and less room for error. And I think that is a risk that I think we all need to be very mindful of going into the back half, although the earnings were good, to be fair.
So what do we do then? Because the broadening hasn't happened, and every time there's a little one step forward of the broadening, it takes two steps back, and the Russell sells off a lot, and we're back to this same top-heavy conversation. What changes it?
Yeah, you know, you're absolutely right, because not only is the expectations high, it's the earnings quality was pretty decent across some of the big tech that we saw. So it is a very interesting dynamic that we're in. It's very difficult to kind of move away from this group because the earnings quality, the beating of the consensus expectations is all checks off from what we saw last week.
I mean, it's really stark, too, when you look in the difference between the earnings growth and the sales growth between mega cap tech and everything else. It's actually stunning how they've diverged so much.
I can't agree more. I think these companies continue, or just tech in general, just given size, economies of scale, great balance sheet, great cash flow, they just have, again, more flexibility to, whether it's increase the dividend or initiate a dividend, buybacks, or even continue the innovation path. That all checks off for some of these big tech
So
names.
we've been hitting new highs, obviously, on the S&P. I'm looking over your shoulder to see where we are now. We're 49.50. Apparently, March doesn't matter. We thought March mattered, and then Fed Chair Powell at the meeting basically wrote it off, and the market had a little bit of an issue for a minute, and then it sort of came right back.
It's funny you say that. You know, when you look at the Fed futures, expectations are still for 6 rate cuts. The Fed is going to meet 7 more times between now and year end, and so until we get to a point where they haven't started raising or cutting rates yet, and there's still 6, you probably still would expect 6 rate cuts again from what the markets are expecting.
When do you think we get the first one?
It's very difficult to say. I would imagine that it could be sometime between June and July, and this is my personal opinion. I think the Fed is, again, trying to be very careful in terms of their initiating this process, as they call it, with regards to the down rate cycle. And the last thing they would want to do is to lower rates or start lowering it, and the totality of the data suggests that that was too premature. That's the mistake that I think they are trying to avoid at all costs.
Well, the other mistake people worry about is they wait too long to start cutting, right? And that causes undue harm to something that they actually don't want to snatch defeat from the jaws of victory.
That is absolutely correct. I think, though, that because some of the economic data points, whether it's the jobs report, suggesting that the economy is still quite resilient, that gives the Fed a little bit more wiggle room to delay the first cut.
Yeah, I felt they keep talking about, I think Chair Powell did as well last night, this idea they almost have an insurance policy in their back pocket that they weren't sure they'd have because the economy is so strong, so they have the ability to remain patient for a little bit longer than maybe the market initially wanted, but I think understands, well, if they're patient and waiting for the right reason and then they cut for the right reason, then we're good.
Yeah, I think so. And I think, you know, the markets need to also be very careful, too, that, you know, the first couple of rate cuts, perhaps that's just taking some of the cream off the top. But when you get to a point where you're talking 5, 6, 7 rate cuts, you know, it could be the beginnings of another conversation. Is the economy resilient enough? And maybe that's why the Fed needs to cut. And so that could be another risk that can bubble up if, again, the rate cut starts to get to that 4th or 5th or 6th rate cut.